now, I will invite Para, who is the President of AFAS, as well as CEO of J Para Solutions, to share a few thoughts with us. Over to you, please, Para.
Right. Thank you, Vivian, for the introduction. Good morning, Nishit, CEOs, FA firms, AFAS members, and fellow practitioners. I'm very sure every one of us have been participating in many webinars, Zoom meetings, or any other virtual meetings ever since circuit breaker measures have been introduced to curb the spread of COVID-19. However, this webinar for AFAS representative members is special to AFAS. This is the first webinar for our AFAS rep members. The response for this is overwhelming, and we have more than 800 participants in this webinar. AFAS has successfully organized many conferences over the past 20 years. We usually have about 450 to 500 participants in our annual conferences. However, in this webinar, we broke all previous records. We have more than 800 plus participants in the room today. Looks like COVID-19 in some way created history for the AFAS members in its own way. For this, a big thank you for the organizing team from both AFAS, Angie, and Aviva, Vivian, and not forgetting you, our members who have taken your time to join us. We are motivated and encouraged to organize more such webinars for our members. The next one is on July 9th, 2020, in collaboration with Income. We'll be broadcasting this event most likely today to all AFAS members. COVID-19 has made us think how we conduct our businesses and manage our personal lives. This crisis has reminded us the importance of savings and investment for emergency funds. I trust our practitioners and employees in the financial industry practice what we preach to the general public. Have at least 6 months of monthly fixed expenses as an emergency fund. Without these savings, we would have been under tremendous financial stress to handle such crises. We have seen how our government is able to roll out 4 budgets within 3 months to help our citizens and country to sail through and navigate through this crisis of our generation. This is mainly due to our planned accumulation and investment from the budget surpluses each year over the last many decades. Likewise, each individual and family needs to have this emergency fund set up to face such crises in future. And who is the best position to help them plan for such emergencies? It's us, the advisors. The non-face-to-face rules have affected many of us. Our profession is a people's business, and need to meet the client face-to-face is paramount important to us. The face-to-face allows us to gauge both the client's emotion and sincerity in planning. Sales is not done on logic alone, but emotions and our relationship with our clients. We hope that we can continue to build relationships with clients and execute the transaction remotely through the technology. Our Elevate channel is facing many challenges, mainly from the online platform, insurers and banks. These and other channels are investing heavily in technology and reaching out to the clients directly, and during this crisis, they are reporting increase in account openings and trades. Is this a big concern for us? Yes, we need to be prepared to challenge this threat. We have a major advantage over the other channels. We are better trained and equipped to give comprehensive financial advice to our clients and prospects. We have multiple solution providers to ensure our prospects and our clients can be solved. Just by talking to us, we are truly a one-stop solution provider. Let's not waste this unique opportunity we have. The management of each FAs are reviewing all their current processes and operations to support our advisors to face this competition. We are investing into technology to compete with other channels with the help of the MAS FinTech DAG support. We want to ensure we stay competitive and become the most preferred channel to get best advice on financial planning. To be the preferred channel, all of us have a role to play. We must always put clients' interests first before ours. Our advice and recommendation must be able to stand the test of time and any audit. We must try to achieve zero complaint to feedback or to costs. We are already seeing a very high A grade in the quarterly basic reporting to MAS, and we must continue to improve this. I truly believe we can, for we are the best. Today, we are truly privileged to have Mr. Nishit Majmudar to talk to us about the important topic, the PAR funds, which is one of the most recommended plans by our channel. Nish is the CEO of Aviva and Deputy President of LIA. Nish has 30 years experience in finance, marketing, sales, and executive management. He worked in India, UK, Philippines, Thailand, and Singapore. Nish holds a bachelor, he's accredited member of the Institute of Investment Management and Research in UK. I had the opportunity to engage with Nish in 1998 when he was the Insurance Commissioner of Insurance in MAS. And I was then the president of LUA, now called IFPAS. Even though that was 22 years ago, he still looks the same, not much of a change. I hope he will say that too about me. A trained actuary is the best person to talk to about the power funds and the implication of COVID-19 and RBC. Once again, thank you to all, and let's learn from Nishi.
Thank you, Para, for your insightful address. So now I will invite Nish, who is also the CEO of Aviva Singapore and Deputy President of LIA, to start his presentation. Nish,
good morning, everyone. And I think some of you all have asked the question as to why is Nishit doing a presentation, and just that we are all on the same page. I was talking to Para about something else, and he said that the July conference was postponed. And I think, firstly, thank you to Para, I think, for inviting me to do this presentation and some of the very kind words that you said about me. I just want to say, I'm not going to say anything today about Aviva. I mean, obviously, some of the stuff that I share relates to Aviva, but there's not a single slide which is about Aviva. I'm trying to talk about the industry. And I have only one objective today, and it's particularly reinforced now that Para said our customers are panicking, are going through difficult times. And my only objective is that I can equip you with some more information on the Power Fund such that you can go and educate and serve your customers better. So that is really the objective of this presentation. I realize that it's been 13 years since I last did a presentation to advisors. So if I'm not at my best, then you know why. I've just lost the sort of routine and the practice of presenting. When I was in Prudential Singapore, I used to do so many presentations. And when I was thinking back of those sort of sweet memories of when I was doing so many presentations to advisors, I always, as a qualified actuary, to break the ice, I always used to have a joke about actuaries. And so if we have time, then I think as we go along, it isn't a new joke. It's one of the old ones, but it's one of my favorites. So when things get a bit technical and sort of you guys get a bit bored, it's too heavy, then just send me a chat message and I will throw in the actuarial joke. The risk-based capital is quite a technical subject. We call it RBC2. The previous regulations was RBC1. I'm not at all an expert on RBC2, and it's evolving. And the way MAS has done is that it started in March of this year, but there is a transition period from one framework to another. So risk-based capital will be fully implemented only, I think, end of 2021. So, I mean, I'll be happy to answer if you have some questions on RBC2, but just sort of a disclaimer to say I'm not really the expert. I sort of understand what's going on, and there may be some questions which even the experts may not be able to answer because it's implemented. And I can also tell you, if you have 10 actuaries in the room, there are 11 interpretations of how the regulations work. So I can only try and give you my interpretation. Please stop me as we go along if there's something that I say. I've tried to put it in a non-actuarial language, and then let's have a little bit of fun. So let's get on to the first slide. I think I will do it in about 20-25 minutes, but if you have questions, then probably. So I think what are we going to cover? So we talk about the participating fund and why the participating fund. So I think it is of the three types of business that we write, investment link, protection business, and participating, this one is the most complex one. And if you look at the non-participating, I think there are not sort of enough, I mean, thankfully, there are not many deaths in Singapore, but from an actuarial point of view, there isn't so much data emerging on deaths or anything else that will affect the premiums on the term business. So I think if we have the participating fund covered, I will also share some of the salient features of the participating fund. Then we'll go into year 2020. So I think the two things together, the pandemic, the COVID, and then the new regulations, and then it's been an interesting one trying to see the impact of the two together. And I will share some of the findings from my point of view, and hopefully you will find it useful when you talk to your customers. I'll talk about challenges faced by the participating fund. And as I said, this is not about Aviva's participating fund. Again, I have not gone and checked all the MAS returns and stuff. So I can only give you a general view of how most insurers would be affected. Some will be affected more, some will be affected less. But at least you will know after this presentation that if you distributing products for that company, you could go and ask them some of the questions, and then you can make up your own minds whether they're doing well, they're more affected, less affected, and stuff like that. Yeah. And then if there are problems in the participating fund, we'll talk about what the way forward is. We need a fund which doesn't topple over. We need a sustainable fund. So we'll talk about what new business, what changes I think there will be in product designs. Will there be a cut in bonuses for in-force business? We'll talk about that. There's one question that hopefully we can have an answer before at the end of the presentation is, are high guarantees necessarily better than low guarantees? And I think why there is a trade-off between guarantees and return. Let's talk a little bit about that. And then I think there's some discussions going on, LIA, MAS, and I'll be very careful of what I say. But all I would say is I will share what the discussions are. There is no decision made yet. And so you know what the future is. And then we'll finish with a summary slide. But as I said, ultimately the objective is that you guys can go out and have more confidence, because there's a lot of communication that goes out from every company. But I think it is always easier if you're listening to somebody rather than reading through the communications going out. So let's get into the slides. And participating fund, I think we probably it'd be easier if we were face to face. I would have asked a few questions, but does anybody know how much? So first we'll go through the product now, and I think this is preaching to the converted, so I won't take much time. So it's a product which has basically some protection and a lot of savings. We call it smooth investment returns. So if you have a 15-year policy or a 20-year, then 1 year's returns are not crucial. And that is, I think, an important point when I talk about the COVID or 2020 returns, because it's quite likely everyone will know that this year's returns might not be great, but that doesn't decide what benefits will be paid out, because we try and smooth out the returns and take an average and sort of then pay bonuses according to that. Stable long-term returns. If you see, most of our PAR products in the industry have got early surrender penalties, and that is because if you invest in equities and property, then you want a slightly longer term horizon, and then hence the contract with the policyholders is to the ones who keep it to maturity are likely to get the best returns, and the ones who surrender early, because at that time equity property prices may be down and the insurer doesn't get a chance to smooth out the returns. It's a great product. I think PAR products are very popular in Singapore, but unfortunately UK and Australia no longer write that products. I don't know all the history of why it's not been a popular product anymore, but I think some of the things that I will talk about, how the regulations get tight, how guarantees can become very difficult to pay when interest rate drops, and all those sort of things can have an impact. But these products in Singapore, and to me, PAR products is a lifeline. And let's go and have a look at so I've got a point to make. How many of you all have heard about a 90-10 rule now? And I think this is quite an important piece to talk to customers now. The regulations stipulate that if you had $10 surplus and you are going to pay out a bonus, you can pay 9 to the par policy holders. If you pay 9, so 90-10, then only $1 can be distributed to shareholders. So no, if you ever hear a comment to say the management will cut all the bonuses to the par policy holders and the shareholders will make a lot of money as a result of cutting the bonuses, that is absolutely wrong. If bonuses to par policies holders are cut, then the money that is available to the shareholders is also lower because it's a percentage. So I think this is a beautiful part of the regulations now, where policyholders and shareholders' interests are very well aligned. So in short, every management team will try and pay the highest bonuses possible to the customers, even if the management team was only thinking of the interest of the shareholders, because this is a regulation. So some countries have got 80-20. I think Malaysia had 80-20. I'm not sure where it is. India is 95-5. So yeah, terminal bonuses, I think there's a question coming through. All bonuses, any bonuses that are paid, anything that is distributed has to go through the 90-10 rule. Okay. How big is the par fund in Singapore? Now, if somebody was to give me an answer on this one, can anybody tell me, do you think that par policies represent 60% of in-force regular premiums? 60%? And would anybody know how big is the size of these premiums? $12 billion. Annually, right across the industry, we pump in 12 billion premiums into the par fund. Our total industry premiums, I think end of March is somewhere around 21 billion, but the par is massive. And that is why I think this is really a lifeline. We must understand what's going on in the par fund. And a lot of our customers have got money invested, savings into the par fund. So let's share a little bit of the par fund next few slides. Let's go and see what's the new business what's the proportion. So the in-force is 60%. The new business is not 60, it's around 50. But if you say total premiums in the industry, again, you may or may not have access to LIA statistics. And so when I say that the total industry sales are about 4 billion, a little over 4 billion, I mean, you may be hearing it for the first time, some of you, because if you don't have access, then there's no way to tell. So now how much is the commission that we are earning on sales of par policies? So if I'm not going into any specific product, but if I say 25% of the 2 billion, then it's about 500 million of first year commission, plus we'll have renewal commission. So how dependent is the advisor community on this product? I think massively dependent. So all of us for this, as I said a few times, is a lifeline for us, and we got to look after this par fund. So if I look at these are LIS statistics as 48, 46, 46. So 48 in 2019. I can't remember what the first quarter numbers were, but it's somewhere there, 48, 50%. It is by far the biggest, most popular product that we have in the industry. So let's go on to the next slide and sort of see what was risk-based capital one. And this is where some of the technical pieces come in. If you guys feel it is too technical, please ask the questions. So let's assume, I mean, it's March, but let's say before that was risk-based capital one. I mean, my sense was that you guys wouldn't sure know what the asset mix is, but again, this is a general number. Every insurer will have slightly different asset mixes. This is not Aviva's number, but this is sort of an average, what I see in the industry. I know that there are one or two companies who invest more than 30% in equity property. But I think generally 30-70 is reflective of the industry. I think you can see that when you sell the products. I think it's on the benefit illustrations policy information and stuff. And then there is a guaranteed return and a non-guaranteed return. So when the product, when you sell it, there is some part which is guaranteed upfront to say, okay, some companies will say that at the end of the term, which is 10 years or 15 years, will at least get back your premium. So there is a capital guarantee. And then all the reversionary bonuses, every time it's announced, it becomes guaranteed. And so I would say at the moment, industry, you will see a very big difference between the products in the FA industry versus the products sold by the tied agencies or the tied bank assurers. And the tied agencies tend to have lower guarantees, whereas the FA market, where it is Aviva, Manulife, NTUC Income, all that, they tend to have high guarantees, right? So what happened in the RBC one was essentially you can have a guarantee, and some products are, whole life can be very long. Some endowments are very long. And we were not required to have bonds, to invest in bonds to match those guaranteed returns of the same tenure. So the returns may be in 25 years' time, but bonds, RBC1 came in, I started the RBC1 discussions when I was in MAS, left in 2000. So I think RBC1 implemented in 2003 or 4. I'm not sure exactly, but at that time, Singapore bond market was not very liquid and not very well developed. So we couldn't ask the insurers to invest in a 30-year bond because there were no bonds at that time. So what happened in the RBC1 was that the guaranteed liability is in 30 years' time, but we were investing in much shorter assets. And that was allowed under risk-based capital 1 without not too much penalties for doing that. And then the non-guaranteed return, as I said, we want to give provide higher returns. And so they were invested in bonds, equity, and property. I think there's a question on UK and Australia. Maybe I can take it after I finish my presentation. Yeah. So just the box on the left-hand side now. So when you say we've got 4.75% benefit illustration, how is that 4.75 calculated now? So again, these are, I mean, numbers which some, equity, if I, as I ask in actuaries, they'll give you 11 answers. So every insurance company will have a slightly different number. Some may have 7, some may have 10, some may have 9, I don't know what. And then the bond numbers are also quite different because it's not a question of what the Singapore bond yields are. Firstly, a 5-year, 10-year, 15-year, 20, 30 years bonds, and all of them will have different yields. And if you're going to invest premiums over a period of 25 years, then you don't know which return to take. But generally, I would say the industry has assumed a 2.5% return on government bonds and about 4% on corporate bonds. Some companies invest in high yield bonds, but roughly there. So if you take the 30-70 and you say 30 into 8% and then 70 into roughly 3.4, then you roughly get a 4.75. So some insurers may think they will earn 5%, but because the benefit illustration is only 4.75, some will think they can earn only, and 4.75 is the max. But I don't see any insurers doing benefit illustrations except for single premiums short term at anything less than 4.75, because if you have a 3-year, 2-year single premium policy, you're not going to invest 30% in property and equity. This is primarily for the regular premium. So this is how that risk-based capital 1 worked and how the investment strategy worked. So now let's get into 2020 as to what has happened. Is everyone okay? The level at which where I pitched it, everyone can understand. No need for actuarial jokes. Okay, we carry on. Okay. So 2020, COVID in 2020, I just checked the numbers this morning, 500,000 infected cases, 10 million, sorry, and 500,000 deaths reported globally. Yeah, so economies worldwide affected, social distancing, lockdown, nothing to do with the power fund, affected sales in a big way. But then the last point is very relevant. Now, the equity market and interest rates take a steep plunge because of the coronavirus fear. And how does that affect the power fund? So let's go and just have a look very quickly. Let's look into the the equity market numbers as well as. So I think most of you would have invested in the Straits Times Index. So I think I don't need to tell you how much it's hurting at this point of time, right? It's about 20% down from where it was in January, probably around the 3,000 mark. And it's now, I think today is 2,600. Maybe 15%, but yeah, I mean, it hurts. At its lowest, it hurt a lot more. Now, it's recovered since in the last 3 months. 3 months back, I think 23rd of March, I think was the worst day right across the world. And you see Dow Jones is down. I think if I take the Friday drop, which was quite a lot, I think it's about 15% down from its highest point. But I think it is the volatility which hurts a lot. So it's not just going down, but I will talk about a stress test. So what the regulators want is they want every insurer to stress test. So what does it mean? It means they want to make sure that we've got enough capital if the markets dropped, say 25%, right? But what happens is the problem is when the market has already dropped 25%, and then you need enough capital for another 25%, then it becomes a problem. And so I won't go into too much detail on stuff. I've tried to keep it at a higher level. But the stress test is essentially we must have enough capital in the power fund. So I think in a normal situation, every company is fine. But after the stress, for another stress, I think that is when it becomes a bit difficult. So equity markets, I'd say that we still think the long-term return haven't changed. So 7 to 10%, 8%, whatever. I think it's a subjective number, but we don't think the long-term returns on equity. So that is good news for the power fund. So 30% that we invest in the power fund looks okay. So long-term returns look okay. Let's look at interest rates. Not so promising, actually. If you look at on the left side, US. So Powell has become quite a popular individual now. As soon as he comes, stock markets are up or down billions of dollars through his speech. Then you look at Bank of England cuts interest rate to all-time low. And I think if you look at Singapore, let's look at Singapore on the next slide. And I'm not sure how many of you all realize this, that what happened since 2000, a 10-year Singapore government bond yield has dropped from 4%. I think Friday evening was 0.94%. Now, and this is, and even look in the last 3-4 years, just in the last 12 months, I think it is, what is now 0.94 is after a drop of about 75 to 80 basis points. So if you look at it in a proportion, so we were something like 1.6 has gone to 0.9. And that has a massive impact on the guarantees that we have given in the power fund, because the interest rate that we are going to earn on future premiums, which you remember there was a slide which shows that we had assumed when we had priced the product that we'd earn 2.5% on government bonds. And now you are going to earn, so if you're going to invest in 10-year bonds today, then you're going to earn 0.94. And a 30-year bond is, I think, is 1.2 or 1.3. So it's not like you can invest in 30 years and have a massive return. It's not nowhere close to the 2.5%. So I think you guys can sort of almost predict what I'm going to say of what the future of the power fund is going to be. This is the most technical slide. So now let's go through this slide, and then we have the actuarial joke, just to such that you all don't find it too heavy. The RBC2, so I think if you guys haven't heard the word Solvency II, which is something that applies to British and European companies, then I'd say you guys are damn lucky, man. Now, I wish I'd never heard that word Solvency II. The actuaries worldwide have made a real meal of this. It is so complicated. And I'm so happy that I don't have to do any actual work these days. But what happens is that the local regulations has to continue to evolve such that in line with markets evolve and how the international regulations evolve. So risk-based capital too has been discussed between industry and MAS for I think the best part of 3 years, maybe even longer. And then, as I said, was implemented in March, but with a transition up to end of next year. What it's trying to do is just to make sure to enhance policyholder protection. So in this case, to make sure that the protection for the guarantees is much stronger, not for the bonuses. Now you can't, bonus is meant to, you invest in riskier assets, you own the returns, you pay. If you don't, then you don't pay. Regulators are not going to require insurers to have to pay a certain amount of bonus, because then it's not called bonus, then it's a guarantee, right? So it's become more tighter for the guarantees that are in the PAR fund. So I will try and explain in the next couple of slides. So one of the things that you should follow is capital adequacy ratio or fund solvency ratio. And I think that is, I mean, insurers will share that with you if you're selling their products. But capital adequacy, you must maintain a minimum ratio, otherwise the regulators can come in. And I think the higher the ratio, the more likely that you'll be able to invest in riskier assets like equity. And the lower the capital adequacy ratio, that means you don't have much freedom. You don't have much capital to take risks, and hence you are likely to be more invested in bonds. So I've said 70-30, but depending on the capital adequacy ratios, different companies will have slightly different asset allocations. So what are the two key changes that impact participating fund? And no, I must insist that what I'm saying is at a high level, general, if you go and ask an actuary, the actuaries will tell you there are many more implications and stuff. But I think these are the two key ones. And so now that the bond markets are far more liquid than what they were in 2004 when risk-based capital 1 was implemented, now MAS expects that the guaranteed cash flows from assets and liabilities should be matched. To say that if you are going to give the product says a guarantee in 20 years or 30 years time, then you must invest in bonds which also will throw out that cash to pay out the guarantees. Otherwise, there is a risk, right? Because you have guaranteed something, and if you invest in something where the cash flow is not guaranteed, which we were doing under risk-based because we didn't have the bonds, but now there is a fair amount of liquidity in the 30-year bond market. This is what MAS expects. Now, I think if you can just see the next slide. Yeah. So what has happened is since the start of this year, insurers know that we are moving from RBC1 to RBC2. We are switching our short-term bonds to long-term bonds to match the guarantees. Otherwise, we need to put up a lot more capital. Capital and risks are two sides of the same coin. You take more risk, you have to put up more capital. You take less risk. So now if I match out, if I buy 30-year bonds and match out all the cash flows on the asset side and the liability side, I don't have to put up a lot of capital. So that was one thing. The other thing that happened was equity and property used to have under RBC1 a capital charge of 16% of the value of the assets. Now it is between 35 and 50% of the value of the assets. And this is only because what we've seen is a lot more volatility in the assets. So if the more volatile the asset, the more capital you should put aside. And that is just a simple thinking. So what has happened is everyone's going to match out the assets, the guaranteed liabilities. And if you can't do that quickly enough, and given that equity markets have dropped, then your capital adequacy ratio, solvency, fund solvency ratio drops. And some insurers may have to reduce the equity investments if they do. So I'm not saying that they have, I don't know. But it is possible that that could have happened if your guarantees in your funds were high and you couldn't match out the liabilities. So this is possible. And if you reduce equity investments when markets are down, you all know what the impact on the long-term returns is going to be. Yeah. So let's look at some of that in the next slide. Okay. So I'll talk about the challenges in the fund. I mean, I think probably we take a 1 minute break and I tell you an actuarial joke, and so that you guys, I mean, when you say, well, this actually keeps talking about such complicated stuff and you need a break. So I will tell you my favorite actuarial joke. There was a lady who was terminally ill. And so this is about, actuaries are seen to be very boring guys and stuff like that. And I mean, I shouldn't say a lot because I'm an actuary. My father's an actuary too. So no, at least respect for him. I wouldn't say much more. But there was a lady who was terminally ill, and she went to see the sort of doctors, and the doctor said, "You got 3 months left." And she said, "Anything I can do?" And she said, "No, that's it, 3 months." Then she said, "I'll go traditional Chinese medicine," and went to them, and they said, "No, you got 3 months. We can't change that." And this lady was obviously desperate to live much longer. And somebody went to that lady and said, "You should go and marry an actuary." And she said, "Really?" And he said, "If I marry an actuary, you mean I will live longer?" And the answer was, "You won't live longer, but it will feel much, much longer." So I think this is unfortunately, but these days I think the actuaries have become far more entertaining. I think we've got a real fun team in the Aviva business. They're all on the same floor as me, and I can assure you that they are far more fun-loving and enterprising than what I ever was. So anyway, let's get back to the challenges faced by. So I'm getting inundated by questions, but no, I'm also happy somebody liked my joke. So no, thank you for that. Challenges faced by the participating fund. I think all we are interested in is, will it adversely impact the returns in the power fund? That's all that we want to answer, right? Because that affects bonuses, and that is all that. So let's look at what are the two things. So we switch from short-term bonds to long-term bonds. Now, first and foremost, I think there isn't a lot of liquidity in the market. So I think insurance industry, life insurance industry has got about 130 or 160 billion funds under management. And so if 60% is power fund, if we all go to buy long-term bonds, there are no such bonds in the market because there's no liquidity. But we've all started to switch. So what happened was we switched from 10-year, 20-year bonds to 30-year bonds. We secure the guaranteed liabilities and reduce. However, by the time we started to do that, interest rates were dropping like a stone. So I think most of us would have locked in at 1.8 to 2%. Some insurers said, "No, it's too low. I want 2.5%. That is what I assumed in the pricing. So I'm going to wait for 2.5 because I got enough capital. I don't need to match it out immediately." I think they may be cursing themselves now, because now, as I said, the 30-year bond yield 1.3%. No, and I don't know, it may go out to be one. But because we locked in at less than 2.5, then obviously long-term, and locked it out for 30 years, then the investment return is going to be lower. And then let's look at the equity. And so I'd say, as I said in the previous slide, I think some insurers may have had to sell off some equities now, because they may not have had enough capital to support these investments. And I don't have any data. I'm just speculating here. And I hope I'm wrong, because from customers' point of view, but I think it is very unlikely that any insurer had so much capital that they actually went from 30 to 35%, which I think would have been brilliant, because when equity prices were at the lowest, obviously if you had invested 5% more in equities on 23rd of March, then you'd be a genius. But as they say, they don't ring a bell when the market is going to go up. So I think these are the two things. So interest rate locking in certainly has adversely affected investment returns. If people have stayed in equities and not reduced it, and so I think long-term returns will stay intact. That's my sense. Now, we are not assuming that equities and property will earn less than that 7-8% that we are assuming in the long run. Yeah, so these are the two big challenges. I'll quickly jump into the last section, second last, and I've got just one summary slide. So what do we think we need to do to build a sustainable participating fund? Let's look at new product designs. This one, unfortunately, I'll have to talk about Aviva for just 1 second. And I think in the FA, not Aviva, but in the FA section, the in the market, the guarantees are roughly around 2 to 2.5%. Okay. So my view is if you want to match 2.5% with yields of, so when we originally did those products, the yields were 2.5%. So we put 70% to match that 2.5%, 70% in bonds to match that 2.5%, and 30% in equity. Now, if where the bond yields are at 1.3%, if you give a guarantee of 2.5%, I think you will need more than 70% of your assets to match that yield. So that rule of thumb is my rule of thumb. It may not be for any other insurer or any other actuaries, but my view is that the guaranteed return should not exceed the government bond yield. So now government bond yield, you can argue it is it 0.9 or is it 1.4 or whatever, different terms is different, but roughly there. I think anybody who does that, I think will not be able to allocate 30% in equities and properties. And hence, I think long-term returns will be reduced. So my point is Aviva has already reduced guarantees. And I think come next year, I think guarantees will go down even further if bond yields don't recover, or if we take a view that bond yields are unlikely to recover. At this point of time, I'd say very clearly, I don't think bond yields are going to go to 2.5% in a hurry. Government bond yields. There has to be a significant amount of growth in the economy before any central government worldwide is going to think of upping the interest rates to that level. From 1.3 to 2.5 is almost doubling. And I think several insurers will begin to reprice to give lower guaranteed returns. Have already done, and I think more will follow. Okay. In-force business, will bonuses be cut? After everything that I said, you guys will be thinking for sure bonuses are going to cut. I'm not so sure that bonuses will be cut. And the reason is we use the word smoothing, right? So would you think that premiums that come now or future premiums may earn less than 4.75 because 70% is in bonds, and bonds in future premium only going to earn 1.3 instead of the 2.5 that we had assumed? Then I'd say yes. Is it possible that future returns could be less than 4.75? I think it is possible, and it's quite plausible. But if you look, you got to look at the returns over the whole period of the policy. So if it's 25 years, then you have to look at the returns. So I just shown some returns. Now, again, these may not be absolutely right. We pulled out some numbers. If you think these numbers are not quite right, then you look at the actual numbers that you have of each of the insurers that you work with. And depends on the whole. So future returns, I think if you were, I think just common sense, you'd think that returns will be lower. But if you earn like 10 and 13% in the past and stuff, then I don't think that you necessarily will see bonus cuts. And I'd say if there are some bonus cuts, I don't think it is a bad thing because it makes the fund more sustainable. But again, I don't know what companies will do. If somebody has invested 3-4% more when equity markets were down, then their returns for this year or just on the equity could be 30% instead of the 7-8%. So I think investment returns would need a brave or a stupid man to predict, and I'm not going to be either of those two guys. I think my common sense just says it 4.75 on future premium is going to be difficult to earn over a sustained period of time. So yeah, will it be cut? No solid answer, but possible. Yeah. Okay. I got one more slide now. So high guaranteed products necessarily better than low guarantees. And talking to some of you, customers like higher guarantees, and I think it's very understandable. But all I think is, if you now have somebody who's offering a 2.5%, 2 to 2.5% guarantee, then I think it's going to be difficult to earn 4.75 because you're putting more money under RBC2. You are required to put more money into bonds to match out those guarantees, and then you got less money left to invest in equities and property. And so I think the guarantees will be met. I think I personally don't see any company going insolvent because firstly, companies are well run, you got good actuaries in there, and then you got a fantastic regulator. So I'm not too worried about the guarantees being met. The guarantees will be met. I think no problem. But I think if your guarantees are very high, then I think the overall return will be slightly lower. So the higher the guarantees, I think the lower the total return to policyholders. You can't have the cake and eat it too. You can't have very high guarantees. And I think you all invest your own monies, and you all know. Now, if you put more, you want a guarantee, you go into safer assets, so overall returns will be lower. And hence, I think when you go forward and you see suddenly that you have one company with a low guarantee, one with a high. If the customer wants a high one, you've got to give them the high one. But you also got to explain to them that no, then the probability of earning that 4.75 is going to be slightly lower, in my sense now. But again, I'm not even qualified to advise, so no, why would you listen to me? Let's look at the last slide that I have. So LI is in discussions. I mean, there is a fair amount of discussions going on. Primarily because 70% of investment in bonds is no longer earning the 2.5. So all the actuaries are now working on what number is a good number. Is it 4.75, 4.74, 4.68, or is it much lower than that? I will not talk about any number. I think it is possible. I think it'll be in the best interest of everyone, for you guys, for customers, and for the shareholders, that we come to a number where we think it is reasonable. It's not a slam dunk that is certainly going to be earning that number, but it is a sensible number. Could it be lower? I think it probably likely to be lower. But watch the space as and when everyone, all the key stakeholders have agreed. Because I absolutely don't envy you guys as advisors to going to customers and say, okay, this is what I projected, but now I'm coming to tell you that bonuses are going to be low. I think that's going to be very difficult. But hopefully I've given you some of the information. So one last slide. This is just a summary slide. And as I said, my only intent for doing this is to give you some ammunition so that you can look after your customers better. Par products, I still think there's a huge amount of education that you guys have to do with your customers. The worst thing I think that can happen for Singaporeans and our industry, and I'm not talking as CEO of Aviva Limited here, I'd say the worst thing happens is now people look at lower guarantees and they stick more money in cash and leave it in the bank. The retirement planning will go backwards. We have to teach them that guarantees have gone lower, interest rates have gone lower, which is in fact, they need to do more financial planning, and they need to invest more such that they do not leave that money in deposits, because the returns are going to go lower there. And I've always said, I used to do a lot of retirement seminars in my past life, that money in banks doesn't mean it is safe. If you're going to earn less than what, at a rate such that you retirement, you're not going to have enough money. So I think what an opportunity for us as advisors and insurers to go and educate our customers. And I think we have the right information, the right sincerity. I'm sure they will all listen to us at this point of time. I think, as I said, I think you should look at total returns, not just as guaranteed returns. And I think I've given you enough information for you to. And I think the last point I'd make is that there is something like financial strength, capital adequacy ratio. Given the volatile times, I think it is important to look at the strength of the insurer. I think it is no longer, I don't think you should take a view that if A company, B, C, and Z, all of them are showing a projected rate of 4.75, that they are all likely have the same probability of earning the 4.75. I think you need to look at the strength of the companies, the quality of the management teams and stuff like that, to see whether over a long period of time, which insurer is likely to, because it's not 4.75, some companies could earn 5%. And I think the last point I'd say, I never look at the par returns between different insurers. It is useful, but it's not, to me, it's not the most meaningful, because different insurers have different guarantees, and hence returns are likely to be different. And so I think you can look at it. It gives you a sense of which insurers are doing well or not. But no, it's not completely apples to apples comparison. But I think all of us can go up a notch. And I hope you all found the presentation worth time. Thank you for listening to me. And I will quickly go through some of the questions that I can see here. And by all means, if you have other questions, then first question I have is from D, and it says, in view of RBC, what is the long-term asset allocation for participating fund? Eddie, I think the answer to that is depends on where you set your guarantees. So if in my mind, if your guarantees are similar to where your yields on government bonds are, then you will have a 30-70 will continue. So 30 will be in equities and 70% will be bonds. But I think if you have a return which is much higher than what you can earn on government bonds, then I think it's unlikely to be able to invest 30% in equity and property. So you will probably get 20, 80% goes. And bonds, I mean, I'm talking loosely. Bonds is not just government bonds. It can also be corporate bonds, but you rarely ever get corporate bonds of 30 years and stuff. I think the risk is too big to hold a corporate bond unless it is something like a real rock solid company. We do not like to hold 30-year bonds for corporates. Will RBC affect, so Henry question, RBC affect new products only or both new plans? It will affect both. And hence there is a transition period, which MAS, as I said, discussions have been on for about 3-4 years. There's a lot of numbers which were done, produced by each of the companies and submitted to MAS. Plus MAS has been very kind to say there is no one implementation date, March of 2020, which was supposed to be. But with COVID and all the stuff, they've given us another 2 years. But yes, it will affect both new as well as in-force business. Can Aviva provide a fund? So this is from Gideon. A power fund return stable for the past decade to us. Yeah, certainly we could. But as I said, the returns that you look in the past and you use that to use for the future, just need to figure out that the guarantee levels were sort of at that time in line with those yields at that time, because asset allocations can change from past to the future, and that will change the returns for the future as well. But yes, we can provide that information. I think there is from Kerry, I think your question is, you mentioned that tied investors tend to have a lower guaranteed as compared. Is it because of higher costs? No, I don't think so. No, I think it is just, it is their decision to have a lower one. So my point is, what happens is if in the FA industry, it is more competitive and more transparent, and the sellers can sell for any other company. So if Aviva had a high guarantee, then I think Manulife and Income and others are sort of forced to it, because otherwise everyone will sell the Aviva product. But I think Tide, you can get away with a lower guarantee. And I'm not suggesting by any means that lower guarantee is worse, but I do know that in the past, higher guarantees have been easier to sell than a product with the lower guarantees. Okay, I think Yung Yong, your question is, are high guarantees necessarily better than low guarantees? Sorry, if clients are okay with low guarantees and total high returns, aren't they better off doing investments instead? Well, I think it's a question of, what we are providing is stable long-term returns. If any of your customers can have the discipline of putting money aside on a regular basis, the way they put regular premiums into the insurance policy, and they think they can earn 4.75, certainly. But my point is, even if 4.75 gets lower, the degree of difficulty to earn that return hasn't got any easier. it remained the same because now guarantees are lower. If you invest yourself, you will still earn lower returns. But what I would say is if you want that 4% plus returns, then the customer should have a slightly longer term horizon, because no insurer can invest that brings the expertise of investing the 30% in equity and property. But I don't think any of us as insurers would want to do it over a 3-4 year period. We'd always like a slightly longer term. So I don't think they'll be better off. I think par fund still has a very important place. How will the par fund be if interest rates continue to tank to a scenario like Japan? Yes, I think I'm glad you asked the question, because negative interest rate or a zero interest rate is no longer unthinkable. Is no longer unthinkable. And that is the reason why we are trying to match all the guaranteed liabilities with guaranteed assets like government bonds. Once we do that, then it doesn't matter for the premiums that have been received. If once you have matched the cash flows, which what MAS is asking us to do, otherwise they put up high capital. Once we have matched those cash flows, then it doesn't matter for the interest. For future premiums, yes, it is still a problem, because then you'd say I'm investing at 0%, whereas my pricing had assumed. So my point is the guarantees will still be okay once we match, but the future bonuses will be definitely likely to be lower. Yeah. And I don't think zero is in sight, but as I said, 2 years back, had you asked me, I would have said I would not even think of it. But now I do think of a zero is possible. And I think there was a question earlier as to one of the why UK and Australia and stuff, and I don't know. But I can tell you that in the UK, there was a very big insurer, Equitable, which went bust. And that was because the annuity payments were priced at an interest rate, which was whatever at that time, let's say 4%. And everyone thought that 2% interest rate was unthinkable. It went to much lower interest rate. And then there was no way they had enough money to pay the sort of be able to invest at 2% and still pay the guaranteed annuities. So the higher the guarantees, the more likely that the insurer could get into a very difficult position. I think I think Alvin, thank you. Thank you for listening. I think I hope it'll help you. Yeah. Do you foresee negative interest rates in Singapore? I've answered that question. Implications are dire. But once we match this one out at the moment. So Aviva was in a slightly, and again, I'm not doing any sales, and so everyone's been hurt by the drop in interest rate. But because UK is under Solvency II, so no, they kept nagging me for quite a long time, and I used to say bugger off now. But thank God that we listened to them and we invested in 30-year bonds before RBC2 came in and stuff. So yeah. I think Liho, your question is Aviva's par fund expense ratio seems to be higher than the industry average. General concern is that it has better consistency in delivering non. I'm not quite sure on the expense ratio now, and I'm just being honest here. I don't know. But better consistent delivering the non-guaranteed returns. Again, I think we'll have to go with data, but I'm not sure Aviva has got a bad record on that. And I've said before that cutting bonus rates reflect the actual investment returns and the insurance experience is a good thing. Because if you don't cut bonuses when you should cut bonuses, then somebody else is going to pay a bigger price in the future. So I think I don't know the past, and I certainly can't compare with Pru and income. I don't have that data. If you need it, then obviously write in and we'll try and figure out what we have to explain to you. But I think the way markets are as volatile they are, a constant bonus rate is going to be far less likely in the future. Now, you will see bonuses go up or bonuses go down. Best to get your email address. It is Nishit_Majmudar at aviva-asia.com. Write to me, but no, I'm not a very good actuary. So no, if you want for research and stuff, but I have a lovely young lady who's sitting next to me, Nicole, and sorry, I forgot to say it. Nicole and Vivian, who's helped to host, she came on, and Nicole is one of our very bright young actuaries. And I said, this presentation you handle, and she was working right through the weekend to get this one ready. So I just want to say a big thank you to Nicole. And if you have any data that you need for research and stuff, then how is a consumer to tell the strength of an insurer? I think you can get capital adequacy ratios, and you should be able to get it, ask the insurer to give you. We should all be able to provide you at the previous quarter. I don't think you can get on a day-to-day basis, but would there be a possibility that a hike in interest would have a negative impact to the par fund? So as I said, once you match out the assets, whether it goes up or down on that guaranteed liability, it won't matter. Higher interest rate, whether it will move equities in a certain direction. Nowadays, the world doesn't follow textbooks. It just goes in any which way they like. Because generally you'd see a drop in interest rates, equity market should go up because people would move money from bonds to equities, but it doesn't work that way anymore. I don't see, I may be in a minority, but as a CEO, I'd say every survey says, what is your biggest concern is a drop in interest rates. As soon as there are guarantees, I'd say any increase in interest rate to me is always a bonus. Now, I love it. It takes a lot of the pressure off my shoulders now. Okay, what is your targeted car? I think, so we always have a car, and I mean, I think the car, you can get the cars for the whole industry number. I'll see where the information is, but Bernard, that information is available. And as I say, you want your car at a certain level. Now, to my mind, you don't want to be the strongest, because in a way you are holding too much, and you rather pay out the bonuses and be at a level where you are strong. But so I always think, what is my first obligation to the policyholder, par policyholders? First one is to be solvent, and the second one is to pay as high a bonus as you can. How does the effect? Oh, I think there are lots of questions. I won't be able to answer all of them, but I think some of your questions I think I've already answered. Given the current RBC2, so Helen, your question is future projection prudent to bring it closer to? No, certainly not, no, Helen. No. So your 70% that you invest in bonds must allow for a lower return, but the 30% in equities, we still think it's going to earn 7 to 10% in the future. So 4.75 won't come down a huge amount. I think it'll still be in excess of 4%. I think, Bernard, you ask a great question. Will the compensation of advisor be cut in view of lower performance of fund? I think it only applies to future sales now. And I think the $1 million question that we have to all ask ourselves is, when interest rate drops, the return to the customer drops. Just take it as simple as that. And if none of us are willing, the shareholder says, I will continue to make the same profit. Distributor says, I'm going to make the same compensation. Then the whole impact of the drop in interest rates or investment performance is borne by the customer. And hence we mustn't load the customer with all the downside that at one day he just says, no, I don't want to buy it. It doesn't give me enough value, which you guys have asked. So, I mean, will any insurer be brave enough to consider a compensation cut? I don't know, but no, should we? I think we absolutely should, because a cut in compensation rate with a lower profit margin, lower costs by the insurer is the only way that we are going to keep customers with us in the long run. Otherwise, at some stage, the customer is going to say, and I do it myself. I don't need all you guys, because ultimately, after all this stuff, I'm not getting enough value. So I think it's a great question, Bernard. I think we all need to think long term. Short term, you can get away with anything, but long term, I think we'll have to think through. Given that RBC affects both, and if LI were to lower, how would old policies sold under the current projections be? So I've told you, that we look at the smooth returns, the future returns, I think will be slightly lower. But if you earned a lot of very high returns in the past, then I think no impact. Yeah, Katrina, I think your question is, will traditional business will become lack of competitive? That's, say, the education piece is very important. To say to people, to customers, don't look just as guarantees. Now you got to look at the total returns as well. And if people accept a lower guarantee, and we are lowering the guarantee because the world's guarantees, the returns have lowered, then I think we will not lose a lot of competitive edge. But education is important, otherwise, without which customers are likely to say, I don't want to buy this anymore. For a whole life par fund, what happens once you exceed the 30-year term of a government bond? I mean, I don't think any insurer can fully match it, and hence there will always be some capital requirements that we'll have to put aside. But my sense is, if you are able to match out for 30 years, you are generally okay. Yeah, there will be some risk, obviously, but I think that is okay. I think no par fund, because we have got bonuses as well. And when you take risk, it doesn't mean that you'll always pay on the lower side. You could earn more than what the guaranteed return is by investing in something other than a government bond. So I don't think anybody is expecting to be fully matched and stuff. Does focus on investment will be better for client? I think if you're Katrina, your question is whether you should sell ILPs and unit trust, and I think my personal view is absolutely certain that you must do it. Our returns, yields to customers on par fund is around 3% at the moment. And I think you cannot have any customer, should not, in my mind, again, I'm not qualified to advise, but in my personal opinion, our customers must invest in funds. Because what percentage of the assets, it depends on the risk appetite and stuff. But if they put all their savings into par funds, it is quite possible that they will not have enough money when they are going to retire. Par fund is a wonderful investment tool, but not for, just like cash, yes, you have for liquidity. But if people put money, leave most of their savings in cash, they are not going to have enough money in retirement. Unfortunately, retirement planning is complex. Now, anybody who says, I put my money in the bank and my money is safe, I disagree. Now, I think you're taking quite a massive risks out there. I think I've answered most of your other questions now. So, Para, is it okay if we stop there?
Right. Thanks, Nishit. I think this session has been definitely useful. What we'll do is, as I've got your permission to upload this presentation to our website, so that anyone who wants to revisit or rehear what we have said can do so at their own time. And at the same time, we'll be sharing this PowerPoint presentation with our members. With your permission, I think the information that you've done, I got a lot of WhatsApp messages coming, said it was very clear, concise, and it was very good. And we definitely hope this session has helped many of our people. The reason, again, I came to you for this session is people out there just knowing that the par fund, the RBs of the card, bonuses of the card, eventually, question of time only. We just don't want to let them know that it's because of COVID-19 alone is being cut. It's just that the interest rate globally has gone down. And therefore, we have to be realistic about how we match together with other investments. And our channel is the best channel to go and educate our clients accordingly with that, because we don't just represent one insurer, but multiple insurers, and everybody is going to come back to the same thing. I'm sure the questions will keep coming in. We won't have time for that. We'll take all these questions under the FAQ, and then we probably be able to reply to them in our websites eventually. If there's no other last parting shot from you, Nishit, I will then pass it over to Vivian to close this session.
I mean, we will try and answer all the questions. I think there's a lot of repetition in the questions, obviously, because some questions were asked before I presented the full, all the slides. But what I have written out, just a message, is that no, it's not just this presentation, but all of you have been big supporters for Viva. So I'd like to say thank you. And I'd say I've written just a chat message to say anytime on anything that if you have a query which you believe that I can answer, please write to me, because no, there is a whole team out here who I can actually seek their help and get to answer your questions, because the world is moving at a very rapid pace, and it's a blanket offer to all of you guys, all 800 of you today, that whenever you have a technical questions or anything about Aviva, whatever, you are welcome to write to me. I'll try my level best to get back to you as quickly as I can. But so with that, Para, thank you. I think the session's gone on a bit longer, but we still have 736 people up there. I'd like to say thank you for listening.
Thank you, Nishit. Again, I must thank all our members who have signed on for this session. We look forward for you for the next session, which is next July the 9th. We'll be talking about technical support, technology support of that. But sign up as a member of us. We are an organization that is in for our channel. We are trying to do the best to ensure that we are responding to the regulation changes. We're engaging with the regulators. We're engaging with the insurers to ensure that we are a channel to be proud of to be, and also, and we're definitely going to be around for a longer time. And Nishit is a big supporter of our channel. Thanks, Nishit.
Thank you, Nishit, Vivian, and everybody for such a wonderful session this morning. Thank you.